And what's so special about Chanakya 3.0? Friends, don't think Chanakya is one strategy. It is like a cricket team. It is combination of 11 cricketers plus 4 extra players. Whoever is not performing will retire. Any new emerging guy will come in, and it will keep evolving. We don't retire the entire strategy family. We only retire some strategies which will face a typical drawdown of 30%. Okay, so we have almost like 6 option strategies and 9 future strategies, and roughly about 60 lots punched across each of these 15 strategies. Okay, 15 strategies into 4 lots, which is officially about 60 lots per client account. Okay, so the beauty of this model is the maximum drawdown mathematically is around 8.5%. It is proven by the fact that last financial year, the maximum drawdown we saw was just 6%. Okay, of course, even though it is 8.5%, we tell our clients, boss, be ready for 20%, because we don't want to tell less. Rather, I would love to say 30% if I really want it. But 20% is a fair expectation, because I don't think we will ever go to that level, keeping the kind of strategies we have in place. And the equity curve is pretty smooth compared to what we have. Okay, and the drawdown is also, it was maximum in 2018, I think, because those days the options slippages were high and liquidity was comparatively low. In the recent times, we are not seeing major drawdowns anyway. Okay, mathematically the strategy P&L is really awesome. Okay, it is capable of almost making like 15% every quarter. But even considering a factor of safety of 50%, let's assume 50% is true, still we will be able to successfully deliver 30% in equity alone. This is the kind of numbers which we are dreaming to achieve through our algorithms. All right. So this is what we intend to do. And we have roughly 15 strategies across all market conditions. We have a combination of low wick strategies and high wick strategies. We have models for uptrend, downtrend, sideways market also. We have done 72 months of validation. None of the strategy we will take live without even testing it. None of our strategy will have any kind of optimization, any kind of curve fitting, no repainting. We will never have any such things, because our models are very balanced in nature. And we have a Kovler ratio of 3+. And though the max quant drawdown is 8.5%, we tell our people, please be ready for up to 20%, which is most unlikely. Okay, so though the average quant output says 5% a month, I am assuming a factor of safety of 40 or 50%. We should be able to deliver 30-36% by the end of the financial year. That is our dream. If you ask me personally, I aspire to deliver 10% per quarter. That is a kind of dream I have. Okay, and please let me brief you about a concept called Kovler ratio. It is simply the average annual rate of return divided by the maximum drawdown. Okay, and a Kovler ratio of greater than 1 is mandatory if you want to take a strategy live. 2 is considered to be good, 3 is very good, and 4 is excellent. In fact, the maximum drawdown in the last 5 years in our quant itself was around 8.5, though we tell our clients 20%. Okay, mathematically it was 8.5, and we have consistently delivered 30% return to our customers. Keeping that, when we calculate the Kovler, our Kovler ratio is close to 4, which means it is excellent by all market standards. Okay, our Kovler ratio is 4, which means our average rate of return divided by maximum drawdown is 4. For example, look at last year only. Last year we did 31.5%, correct? And last year drawdown was how much? 6%, right? So if I do that, if I try to calculate 31.5 divided by the 6% max drawdown, my Kovler comes to 5. But this number is not logical, because for Kovler calculations, you need minimum 3-year data. Okay, so we are very close to 4, and it is much balanced. Okay, and Dr. Prasad is saying, what is the sharp and sorting ratio? Dr. Prasad, I strongly prefer Kovler, because Kovler is much superior in terms of delivering the numbers, because Kovler is a pure function of risk and return, direct. It's like your risk and reward. Now coming to the innovation into the future, Of course, I spoke about Chanakya 3.0 till now. So our R&D team is going to work on Chanakya 4.0 going forward to build much robust strategies for the upcoming year. So the current algos mostly run on Bank Nifty and very few trades happens on Nifty. All the strategies we are trying to build for Nifty also, which can smoothen the equity curve. And additionally, the demat fund is always idle after 3:30 because market runs from 9:15 to 3:30. Okay. So and so what we intend to do is we want to build some commodity trading strategies, okay, where we can focus on gold, silver, crude, so that we can continue to trade on the same account from 3:45 to 10 p.m. So this is something which we are already working on. Maybe 6 months down the line, we will be in a much superior position. And we can improve the overall performance by another 10 to 12%, because even if I earn about 1% every month in commodities, I think that will add up to the overall performance. All right. So these are the innovations we have planned for Chanakya 4.0.